It's really good to be the general partner of a large private equity fund, and I mean really good. A large percentage of the Forbes 400 work in private equity. As one investor put it, it's truly a tails I win, heads you lose proposition. While most investors spin their wheels trying to find compelling one-off investments, the general partners, GPs, who run private equity firms are quietly collecting management fee streams that look like a bond, yet with the large upside potential of leveraged equity. So the downside for the GP equals large management fees, and the upside is large profits from other people's money. Normally, to get huge returns, you have to take equally large risks. Not if you're a general partner. They use other people's money and a lot of bank debt to purchase assets. They get maximum leverage for minimum risk. This is why I think private equity is probably the best business model in the world. And the good news is now investors can actually participate in those GP economics by buying into minority positions of these private equity firms. Not investing in one of their many funds, but rather buying a minority position in the firm, the PE firm themselves. This is called GP stakes investing, and it's one of the most overlooked wealth compounding corners of private markets. I'm Brad Johnson, managing partner at Evergreen Capital here in Newport Beach, California. We advise high net worth investors on tax-efficient private market investments. Our leadership team has guided more than $100 million in private investments across multiple strategies. And so in this video, I'm going to cover why I believe GP stakes investing is so compelling and why we believe it's a superior way to invest in private equity. Here's what we'll cover. Number one, the core idea. What exactly are GP stake investments? Number two, how does it work? Number three, how do GP stake investors get paid? And number four, why would world-class GPs be willing to sell a minority stake? In other words, if it's so good to be a general partner, why are they selling? This is a great point and is by far and away the most frequent question high net worth investors ask when evaluating GP stakes. All right, so number one, what is GP stakes investing and why is it so compelling? There really is nothing stopping anyone becoming a private equity investor, aka a general partner. However, the typical path to an elite private equity position is near perfect grades and SAT scores, Ivy League undergrad degree, or a top MBA program. Spend a couple of years killing yourself for a Wall Street firm as an analyst, then grind it out for a few years as the junior deal guy who lives in the office and probably gains 20 pounds from stress eating, then become a VP, somehow maintain a functional relationship at home as you're flying around the country to random air conditioning or manufacturing trade shows trying to woo an aging business owner to sell you his baby, his business. Then maybe after 10 years you make partner, and then you get to fly over all around the world again with your hat out asking for people to give you money for Fund 8. Now, you can do all that, or you can invest in GP stakes and skip that. You can effectively leapfrog into a senior silent partner that just sits around and collects the checks. No 70-hour work weeks, no red-eye flights, no closing dinners, no countless board meetings. Now, I'm being a little dramatic, but I think you get the point. This doesn't mean that GP stake investors are going to get to buy an NFL team like so many private equity general partners are doing these days, but your capital is shoulder to shoulder with the partners of these firms. You get your pro rata share of the firm's management fees and profits. Okay, but what does that exactly look like? Number two, how does it work? Let's back up and make sure we get the mechanics straight in this case. So a quick refresher, in private markets, you've got LPs, which are limited partners. They invest money into funds, and then you have GPs, the general partners, who manage those funds and earn fees. A GP stakes investor buys into the GP itself, not their funds. So instead of funding one 10-year fund, say Fund 8, you're buying a slice of the asset management business that launches those funds, collects those fees, and earns carry on every deal they do. Carry is the profit of those funds. And those management fees are contractually locked in for a decade at a time. And they're backed by institutions like CalPERS, Harvard, or Yale's endowment. This means if a GP raises just one more fund at the same size as its last fund, a GP stakes investor can recoup most of their capital on the asset management fees alone. Even in the worst case draconian scenario, where no new funds are ever raised again post your investment, the existing fees from the money already invested, we call that money in the ground, could still potentially return the majority of your capital back. Because, once again, those management fees are contractual. Now, no investment is bulletproof, but that structure provides a layer of downside protection you rarely find in private markets. A GP stakes investor is buying a minority stake, usually 10 to 20%, in that general partnership, private equity, private credit, or real estate platform. All right, number three, how do GP stakes investors get paid? There are three main revenue streams. One, their management fee income, which is recurring and contractual cash flow. Two, their carried interest, typically 20% of the profits of each investment. And three, the appreciation of the asset management firm itself. So as AUM grows, the valuation of that firm grows. So this is bond-like income with equity upside. You get an ownership piece of the asset management company, but you don't get a vote in how the company is run, but you do get your fair share of partnership distributions. Now, if this still isn't clicking, I'll give you a metaphor. Imagine Taylor Swift offered to sell you a 20% stake in everything that she does. Her label, her catalog, her brand, every concert ticket, every streaming royalty, every merch sale, all of it. And you get a discount because it's minority interest, because you don't have a say, or frankly, do you want any control in Taylor Swift's business? She seems to be doing a pretty good job of her own. You just get to collect the checks and you stay out of her way. In other words, you pay a below market multiple on her actual cash flow and you collect a percentage of her checks forever. That's pretty much GP stakes investing. Okay, section 4. Why do GPs sell stakes in these businesses if they're so great? Why would the owners ever sell? This is the goose that laid the golden egg. Why are they going to sell? Well, it's a great question. And there's 3 big reasons why. Number 1, growth capital. New firms mean bigger co-investment checks from the partners. 3% of a $10 billion fund is $300 million. I don't know about you, but I don't have that lying around. And despite their success, neither do PE firms. This gets worse as they get bigger. And they add more strategies, and they add more funds, and every couple of quarters they are raising a giant new fund. Number 2, strategic expansion. Maybe they want to launch a private credit arm or open a new business line in Asia. That takes new capital. Maybe they want to buy a new team. Okay, number 3, succession. Many private equity founders are in their 70s or even 80s. A GP stake sale helps transition ownership to the next generation. These businesses are still private, so they need funding to continue their growth. The largest private equity firms like Blackstone, KKR, and Apollo solved this problem by going public. They can issue shares overnight and dilute existing shareholders to raise all the capital they need. The PE firms that want to remain private and avoid the hassles of being a public company, they don't have this luxury. So for the GP stakes investor, this creates opportunity. You're stepping into one of the world's best business models at a discount versus public market peers, largely because the founders need liquidity and growth capital, not because the profit engine's broken. All right, conclusion. GP stakes investing is about owning a share of world-class investment firms. It offers 4 rare traits in one package: durable cash flow from management fees, equity upside from carry, profits, and growth, diversification across strategies and vintages, and asymmetric risk-reward that favors long-term holders. Now, if this changed how you think about private equity, go ahead and connect with our team at Evergreen Capital via the link below. We help qualified investors access institutional-grade alternatives. We're looking forward to connecting. Thanks for watching.